All right, let's get started. Hi, everyone. Thank you for joining us today. This is Lloyd Lobo with Traction and Boast.AI. We've been doing these Traction webinar series and have been hugely successful. Most of our content is audience generated, or rather audience suggested, and then we find speakers. Today's session is brought to you in partnership with Launch Academy, Boast.AI, and Espresso. We're talking about everything you need to know about venture debt versus equity. And so I'm super excited about this topic. We get asked about it a lot. And it ties into some of the recent sessions we've done on raising a Series A and M&As. And so now venture debt is very timely. I'm excited to have an expert in the space share his insights. So let's give it up for Will Hutchins with Espresso. Will, take it away.
Super, thanks. Can everyone, can you hear me okay, Lloyd? I won't ask everybody else on the line, but is the audio working okay?
I can hear you clear.
Super. Well, thanks, Lloyd, and good afternoon, everyone. Thanks for joining us. My name is Will Hutchins. I lead origination for Espresso Capital. Pleased to be here to talk today about venture debt. I hope it's going to be an informative and also interactive discussion today. We're going to cover off a couple of things, a couple of topics. What is venture debt? How it works? Why it makes sense for founders, investors, and boards to consider using venture debt as part of an overall financing strategy for their growing technology companies. Just before we get started, very briefly, a little bit about our firm, Espresso. We're an active venture debt firm focused on the tech sector. We were founded in 2009, and our firm has provided non-dilutive growth capital to over 250 companies at this point, with a current active portfolio of more than 50 companies today. While the majority of our work is in the software space and primarily SaaS companies, we work with fast-growing companies across the sector, and over the years have financed companies in subsectors such as digital media, life sciences, clean tech, and robotics, just to name a few. We'll talk about this in more detail at the end of the presentation today, but very generally, our funding solutions take the form of credit facilities, generally operating lines, ranging in size from 1 to 10 million. And I think perhaps most importantly, as a firm, we're highly passionate about helping founders and their early investors and employees achieve their goals and build companies, and believe that for many, venture debt can play an important role in that journey. So why are we having the conversation? Why is the discussion about venture debt relevant or important? It's important for the simple reason that for a long time it's been commonly accepted wisdom that fast-growing technology companies should really fund their growth entirely by raising equity. First from friends and family or angels, and later by raising a large equity round from a traditional VC firm. And indeed, for many entrepreneurs and founders, there's I think a perception that raising that large equity round from a name brand VC is something of a badge of success, of a validation of the idea or the technology, and the potential for the business to be the next unicorn. And that's a perception, of course, that's reinforced by the daily reports that we all see of kind of the latest VC rounds, new and minted unicorns, and the promise of a huge VC-backed IPO. But while much of the attention is focused on how and from which firm to secure VC funding, I think what's discussed less often are some of the important considerations around raising large equity rounds and financing, and the implications such rounds can have on founders, the employees, and the company's early investors, particularly in a capital raising strategy that is equity only, if you will. The first, of course, is dilution. It's the founder and the early investors, I said often friends and family and early angels, that really suffer the effect of dilution the most associated with large equity rounds. And as we'll see a little later in the presentation today, our research suggests that a typical founder will give up to almost 50% of his or her company by the time they complete the Series A, and sometimes as much as 60% of the company post Series B. And that can have a significant impact on the ultimate financial outcome for the founder and the early investors, of course. But it also raises important considerations beyond just the financial impact on exit. And key among those considerations is governance. As we all know, institutional investors will always require some combination of governance rights in order to protect their investment, and I think we would all agree that's reasonable. Very often, this includes a seat or seats on your board. But beyond the board, these investors may also require specific approval rights on key issues such as the strategic direction of the firm, key hires, compensation, how the company may raise additional capital, and importantly, when and how the company may seek an exit. And generally speaking, the more capital you raise from early institutional equity investors, the greater their ownership position in the company, the more extensive the rights those investors will acquire. And this can, of course, have significant impact on how the business will be run going forward. Raising a large equity round also serves to trigger a valuation of the company. This isn't a bad thing in and of itself, of course, but depending on where the company is in its evolution, the timing of that valuation can be very, very important. To the extent possible, you really want to try and optimize the timing of your equity round, your equity financings to maximize valuation, of course. And this can mean timing your raise or seeking to time your raise to occur after a new product or feature is successfully launched or upon reaching an important revenue or other operational milestone. And as we'll discuss later, the ability to optimize the timing of a round is an important reason many companies look to raise venture debt capital. Finally, raising equity is, as we all know, can be a time-consuming and challenging process, something that requires the full attention of the CEO and the executive team. That process of preparing to go to market, conducting first meetings, managing diligence, sometimes with multiple parties, and ultimately negotiating terms can often take up to several months. This means not only that it takes several months to secure the funding you need, but it also means, of course, that the CEO and key members of the management team will be significantly distracted during that period. So, somewhat ironically, this can negatively impact the performance of the business at the very time the company needs to be strong momentum. Ultimately, of course, with success. So having identified some of the key considerations associated with raising equity, the logical question is how can companies seek to mitigate or address some of these considerations? And for many companies, the answer lies in exploring alternative or complementary funding sources, and specifically venture debt. So what is venture debt? It's in very general terms, it's a form of we thought of as a type of non-dilutive financing that complements a company's equity funding sources. Among the most common ways companies use venture debt is as a means of extending their runway or bridging themselves to a future equity financing round. The additional funding, for example, before a Series A or in between rounds can enable that company to continue to ramp, gain greater scale, or achieve an important operational or other strategic or financial milestone before they go out and raise that equity round. And as we'll see later, we've seen a number of companies in our own portfolio effectively leverage venture debt to help them pass the typical Series A or B valuation levels, enabling them to secure much larger valuations and as a consequence materially reduce the dilution they experienced when they finally did go to market. In some instances, venture debt can be raised concurrently with an equity raise, enabling the company to maximize total funding. Or alternatively, you can use the same approach to reduce the amount of equity you're raising, thereby seeking to optimize the valuation. And finally, many firms will look to venture debt as a cost-effective means of financing important capital investment, or in many instances, using it to finance strategic acquisitions, strategic M&A. The venture debt financing generally takes the form of a term loan or a line of credit, and as we'll discuss in a little more detail in a moment, that capital should generally be used to accelerate growth versus prove out market fit or fund the very early stages of company development. And finally, it's important to distinguish venture debt from other debt capital, particularly senior bank debt. Importantly, these are funding solutions that have been designed really for businesses which generally don't otherwise have access to traditional bank or senior lending solutions, generally because their asset value is driven largely by intangible versus tangible assets, and in many cases because they're continuing to invest heavily in growth and therefore burn cash versus generate cash. So with that background, what are the advantages to raising venture debt as part of your overall funding strategy? Well, as we touched on, of course, it's non-dilutive, and this is really the critical differentiator, and among the key reasons, of course, that companies raise venture debt. Venture debt is really designed to be a non-dilutive complement to a company's capital structure. While some venture debt facilities may carry warrant coverage, it's generally nominal relative to the dilution triggered by a traditional equity raise, of course. And certainly, true venture debt is not convertible debt. So it's really meant to be a non-equity solution. Because it's non-dilutive, venture debt enables founders and their early investors to maintain control over their company longer. And this is really a key non-economic driver. Using venture debt to extend the runway and improve valuation prior to raising equity will often position the company to secure better terms for the next equity raise, give up less equity, and of course relinquish less control over the company and key decisions post capital raise. And finally, venture debt is flexible. Certainly relative to equity, venture debt financing can be secured reasonably quickly, and importantly, it can be repaid in the event that the company's circumstances change and it no longer has a need for that capital. For example, if the company raises equity or reaches a scale where it can access lower cost capital from a bank or other senior lender. We've talked about how using venture debt can help founders and early shareholders minimize dilution and retain control, but maybe let's look at some numbers to put this all in context. This chart shows the difference between insider ownership under an all equity financing strategy compared to one where the company raises a third debt and 2/3 equity for each of its seed, Series A, and Series B rounds. Now, we've used aggregated round sizes and valuations from PitchBook, so of course this is really meant to be indicative. But as you can see from the table, even substituting debt capital for 1/3 of your total capital funding over time can have a pretty dramatic impact by the time you reach the Series B round. In this example, insiders would own around 40% of the company post Series B under an all equity scenario, but more than 50% under a scenario in which the company's incorporated debt at each step. So not only does this of course have meaningful economic implications for that group, but it's also critical to note that by using venture debt, those insiders have effectively been able to retain control even post the Series B round. And the difference is even more pronounced under a scenario where the company is able to leverage venture debt to effectively skip their Series A and fund the company through to a Series B, for example. In that case, as you can see, founders and insiders have the opportunity to retain as much as 60% or more of the equity post the Series B. Obviously, a very attractive outcome for that group. The next slide just highlights a few examples of companies that have successfully used venture debt to achieve very, very positive outcomes. Companies like BoostBuy, Stafflow, and Intraphi have used venture debt funding to significantly extend their runway. And in doing so, they were able to gain significant scale without excess dilution, and then go and raise what, by some measures, would be effectively a Series B round. For example, Group by effectively skipped its Series A, gained scale, and then raised $15 million from the USVC firm Peakspan. And companies, Snapflow and Introhive have followed a similar path. Rise and Homestars each successfully leveraged venture debt to drive growth in their businesses and position themselves for, in the case of Homestars, a successful acquisition, and in the case of Rise, an investment from a highly strategic partner. And finally, the Q4 story really illustrates how some later stage companies can use venture debt in combination with other debt financing solutions to ensure the company has sufficient funding to achieve certain operational milestones before raising large equity rounds. In the case of Q4, a $43 million Series C from Napier Park. So once you've made the decision to raise venture debt, the next question becomes, from whom? There are a number of venture debt firms active in the North American market today, offering a variety of deal structures. Today, we're going to try and highlight a few of the key things to think about when considering a venture debt partner. First, it's really important to consider how the structure of the facility will impact its cost to the company. And in this example, I'm really referring to the dollar cost. Under term loan structures, very often the entire amount of the venture debt loan will be funded on closing. And for some companies, this can result in a suboptimal capital structure in the near term, as the business will take some time to deploy that new capital. And in the meantime, we'll be paying interest on what can be a significant amount of cash on its balance sheet that it's not using. So creating effectively some drag on the balance sheet. Other structures, operating line structures, for example, provide companies with the flexibility to draw down capital as they need it, reducing the amount of interest the company pays on the loan, and ultimately, in some cases, providing a more capital efficient financing strategy. So it's really important to kind of weigh the differences between these various structures and understand how quickly you'll be using the capital, and how well the capital flows under the loan will map or match to your capital requirements over time. Of course, related to that is the question of amortization. Amortization schedules can result in a pretty significant cash drain on the company, just as it's investing for growth. The effect of those amortization schedules can be that the company really does not have access to the full amount of the loan over the entire term. And this can cause some companies to need to refinance these loans early, sometimes incurring unanticipated breakage costs or expenses. Other structures provide interest-only payments over the term of the loan, generally with a balloon repayment on maturity. Sometimes that can provide a better match with projected cash requirements over the life of the loan. Again, it's really something that is kind of specific to the company and your outlook on cash requirements over that period that drive that decision. A key element or a key reason you raise venture debt in the first place is that it's flexible. Because as we all know, the only thing we know for sure is that things won't unfold exactly as we think they will, especially when you're building a fast-growing technology company. In some instances, the company may need more capital than planned as it grows. In other cases, the company may find itself with excess liquidity if, for example, it opportunistically raises capital or kind of moves to a model where it's largely kind of customer funded. So many venture debt facilities, and particularly term structures, will be fixed in their size at the outset of the loan. Many will have prepayment fees or penalties, and it's important to understand how these work, because if they are onerous, they can significantly impede a company's ability to react with agility to changing circumstances. For borrowers that want to maximize their flexibility over the term, we often suggest looking at operating lines that can have the ability to grow over time, provide greater credit capacity as the business grows, and also provide some measure of flexibility when it comes to payment. Most lenders, of course, will be targeting some minimum term for the investment, but it's critical to really take the time to understand what those provisions could mean for the company in the context of your 2 to 3 year plan to ensure that in taking the loan, the company isn't unnecessarily impeding its ability to execute on its strategic plan or simply raise capital in the future. Related to this, cost. You need to understand the cost. Just as it's important to understand the preferences and economics embedded in a venture equity deal, it's equally important to take the time to understand all the costs associated with a venture debt financing. In addition to of course, to the interest rate, the annual interest rate, structures can include other upfront fees, administrative fees, standby fees, payment fees, among others, and of course sometimes warrant coverage or other types of equity kickers. These fees may not necessarily be unreasonable. It's just critical to take the time to analyze and understand just what exactly the all-in cost of the facility will be, because of course, all of these things are incremental. And in general, I would say that simpler is better. More transparent fee structures are preferable. They contain fewer surprises for borrowers down the road. Covenants, very important area. True venture debt will have, of course, fewer covenants than you would expect to see in traditional senior traditional senior debt or working capital loans. And that's for the simple reason it's really meant as growth capital for growing companies and therefore to bear more risk. I think venture debt loans that contain overly restrictive covenants can effectively pose a danger to the company over time, putting them at risk of covenant breach and default, and in some cases significantly reducing the amount of capital that is actually available to the company over the term of the loan. So it's really important to understand and model out how any proposed covenants will operate in the context of your financial plan. Take the time to ensure that all of those covenants work in a way that is kind of consistent with how you expect to run the business over that period. Kind of switching from structure to partner, it's important that any investor or any partner capital partner that you bring aboard understands that the venture growth journey is not necessarily a linear one. While any investor, including venture debt lenders, you have a responsibility to their investors. Experienced venture debt lenders will understand that no growth journey is a perfectly straight line, and that fast-growing companies are by their very nature less predictable. You want to work with a partner that understands that journey and goes the extra distance to support and help ensure your ultimate success. And you want to have and you want to ensure that your partner has appetite for that risk, understands that risk, and most importantly, has a reputation for working with borrowers to secure or achieve positive outcomes for all stakeholders when those risks materialize and things don't go according to plan. You really want to, if the lender does not have that experience, or if the institution doesn't have the ability to work creatively with the company to ensure the company gets to the other side, the company just may be unduly fettered in its ability to take the steps to overcome those obstacles and succeed. And I would always suggest or recommend that people do their diligence in this respect. And this is the type of insight that is kind of readily obtainable by just calling former clients of the firm, understanding what their experience was. So finally, one of the last areas we want to make sure we cover off today is, how to know if you're, how do you know when your company is indeed a good candidate to use venture debt? This of course is it's not an easy question to answer in 3 slides, but some high-level considerations as you evaluate venture debt for your company are, one, where are you in the company's life cycle? If the company hasn't figured out its product market fit, it's probably too early for most forms of venture debt, and equity financing is likely the more appropriate choice. Debt is really the right choice when you've really pinned down the business model and sales strategy, and are simply looking for capital to drive that top line growth. Second, really venture debt is best suited to companies that are growing quickly. These are companies for which the value created through the investment, taking on the capital, i.e. in the form of revenue growth, really exceed the cost of that capital. Just as important, of course, is that you're able to grow efficiently. So, if customer lifetime value is low due to higher churn, or lower margins, or customer acquisition costs remain too high, then really venture debt probably doesn't make sense at that stage. And the company would probably be better served to equity fund that leg of its growth, as it takes the operational steps necessary to optimize some of those metrics. And finally, you have a clear idea of how to invest the proceeds of your loan. Of course, this is equally true of the decision to raise any type of capital, but having excess debt capital, or for that matter, equity capital, without a strategy to invest that capital profitably, can be a mistake. In the case of debt capital, of course, it results in excess interest costs with no benefit. But in the case of equity, it simply results in unnecessary dilution for the founders and early shareholders. I'd say in either scenario, there's a real cost to raising capital if that capital is not deployed to drive real value and growth in the business. So with that context, and I see a couple of questions, and I'm certainly going to get into those as we wrap up here in a moment. But brief note on kind of how this all unfolds. One of the key benefits to raising venture debt is that it can be done relatively quickly if you're working with the right partner. We at Expresso, we've streamlined our processes over our experience of completing at least 700 plus loans at this stage to enable us to fund companies end to end in as little as 30 days. Naturally, the length of the process will vary by lender and complexity of the situation, but it's generally going to follow a relatively standard series of steps set out here. A couple of things to note about process. In my mind anyways, it's a good idea to receive an indication of terms from the lender as early in the process as possible. It's obviously you don't want to do that prematurely, because the lender has to have the facts they need to properly assess the situation and the credit, but certainly kind of getting that indication early on can help avoid wasted time and effort of proceeding through a diligence process only to discover that the terms on offer are not acceptable to the company, or simply not competitive with other options you may be looking at. Of course, another key part of the process is diligence. I would suggest that it's a good idea to ask your lender upfront about their process, and in particular, how long it typically takes them to complete due diligence. Experienced lenders with access to the necessary information should generally be able to complete due diligence in a matter of weeks. It's certainly something that should be measured in weeks, not months. Otherwise, the process, I think, is probably dragging on unnecessarily. And then finally, legals. This is an area where you're going to see wide variation among lenders. Of course, there's variation depending on deal structure, but It's not unreasonable to ask your potential venture debt partner for examples of their legal documentation up front. This can give you an early sense for the complexity of those documents and an idea for any, of course, restricted terms, covenants, provisions that may be hidden in there. And of course, the expected cost for completing the transaction. In our view, legal documents should be kept kind of as simple and as streamlined as possible to avoid confusion later on. So I know that was a reasonably quick overview. A bunch of these topics are probably big enough to warrant their own discussion, but hopefully that was a helpful overview of what it is, how it works, and when it should be used. I see a couple of questions which you can jump into, but one of the main things we want to leave people with here is the knowledge that there are options in terms of how you fund your business, and that in the right circumstances, venture debt can provide a very powerful complement to equity, bringing important benefits for not just the founders and their own investors, but of course their employees as well, enabling them to minimize dilution, maintain control, and ultimately drive better outcomes for all the stakeholders. The other important point, of course, is there's a wide variety of venture debt firms and a wide variety of venture debt structures. So it's important to do your research in terms of choosing the right firm, and of course, understanding how that structure is going to work alongside your financial plan over not only just short, but the medium and longer term. And so with that, maybe just very quickly, just to kind of give you a sense for what these types of things can look like. Our firm, Espresso, we focus on providing credit facilities of anywhere from $500,000 at the very low end to upwards of $10 million. We offer a variety of structures which we've designed to meet the needs of companies, different business models. For example, for SaaS companies and other companies with very predictable revenue models, including transactional revenue models, we offer operating lines ranging in size up to 24 times the company's monthly revenue. So, for example, for a company generating, say, $250,000 of revenue, monthly revenue, with the right metrics, this can translate into a facility of up to $6 million out of the gates, which of course can grow over time as the company grows that revenue. We also offer working capital, accounts receivable like facilities. For us, these facilities are currently structured as true operating lines, not factoring facilities, which makes them a little bit easier, more flexible to implement than traditional factoring line. And of course, for our Canadian friends, we offer tax credit financing, enabling companies to simply accelerate their cash cycle, providing them with capital upfront to continue to invest in R&D and product development. So for many of our clients, we're able to provide loans for up to as much as 100% of their forecast tax credit entirely in advance, and so that effectively accelerates the cash cycle by as much as 18 months, more depending on where you are in that process. So that concludes the formal part of the presentation. I'm happy to kind of answer any questions. I see a couple lined up in the queue here. Lloyd, do you want to?
Yeah, definitely.
Moderate that, or how would you like to do it?
Yeah, I'll definitely moderate that. And Will, thanks a ton. Super, super, super informative. I think a lot of people are confused on the topic of venture debt, and everyone thinks about going for a fundraise. When they think about that, they think about equity, whether that's angels or institutional VCs, and that debt seems to be pushed to the side, but it could really help you preserve your equity in the company. So a few questions here for businesses that qualify for an SBA-backed loan. Is there any advantage to venture debt as opposed to going to the SBA route?
So, I think this all comes down to the particular circumstances of the business, right? I think, you'll see in my experience, for example, we have many clients for whom who may have access to bank debt, for example, And so they'll, in some cases, depending on how much capital they'll need, if they need a small amount of capital, but can be really satisfied via the bank route, they'll go that route. If the amount of capital they need exceeds what the bank is able to provide on a standalone basis, they can look at either a standalone venture facility, or in many cases, we have clients for whom we're providing a senior and sub type structure, where the bank, true senior lender, is providing that first layer of capital at a bank cost of capital, which of course is going to be less expensive. We come in behind that to really provide the layer of the capital layer effectively between bank debt and equity. And so some of those two pieces can often, can provide A, to meet the total capital requirements, but B, what's really exciting about those structures in my mind anyways is that on a blended cost of capital basis, you can get to a place that's really compelling relative to straight equity.
Fantastic, fantastic. And then there's a question around differentiation between revenue financing, venture debt, and I guess there's different formats of this, and you talked about it in the different products you guys offer, SaaS, working capital, tax credit. Perhaps you can dive into the mechanics a little more of each of these and how you look at them.
Sure. I think I'm just looking for the question on the screen, but if I understand correctly, I think what the question is focused on is the distinction between kind of a venture debt loan, revenue financing, and royalty financing. Is that correct?
I think
that's what I see. Yeah, that's an important distinction. It's a great point. Certainly our facilities and most venture debt, quote unquote venture debt facilities would really be priced with an interest rate, right? There's a set interest rate. It's payable monthly, and it doesn't vary over the term of the facility based on company metrics or anything of that nature. A royalty loan, as it often referred to, is something a little different. Those loans, effectively the interest rate is calculated based on a formula that includes the growth in the company's revenue. And so what can what that can mean is that you have less visibility on what that loan will ultimately cost you, and in some cases, it can lead to a situation where the more successful you are, the more the loan costs. Now, again, devil's in the details, so I don't want to overgeneralize, but at a high level, that's the distinction, and it's an important one because sometimes those royalty loans can, I would suggest, be almost a little bit closer to the equity side of the capital structure than the senior bank side of the structure. Lloyd, still there?
Yes, I'm here. This is a funny question here. Are you still considered to be bootstrap if you take venture debt? So I'll give you the example of us at Boast. I consider ourselves bootstrapped, and we've taken debt through the years. We haven't raised equity, and we might down the road, not 100%. But I think if you're taking debt, you are considered bootstrapped. But Will, I don't know, you might want to comment on that.
Yeah, it's an interesting question. I would agree with that. I think if you're using debt at various times over your evolution just to simply help fund that growth, but you're not getting any incremental equity, then I think it's fair to say as bootstrap, look, at the end of the day, if you get to a point where you've built a larger business using bootstrapping, using debt, and you look back and you still own a very large equity stake in the business, then ultimately that's it's the same end result, right? And so I think that's really the important piece.
Yeah, definitely. Given the lack of traditional security or equity upside, and given the earlier stage of venture businesses, what is the upside for the venture lender?
Yeah, it's a good question. So I think what the venture lender is really looking to do is match risk and return, right? So um, certainly, venture lenders don't expect 20% plus IRRs, 30% plus IRRs, in the same way that equity investors do. And by the same token, we don't necessarily take the same risk as equity investors. Um, true venture debt loans are generally secured loans, right? So they're not dissimilar to bank loans in that respect. Um, we're obviously playing at a different segment of the risk curve so that the returns are higher, but that's kind of compensating for the risk. So I think really the investors in venture debt, if I could put it that way, are really not looking for those large returns. They're really looking for kind of a consistent yield at a certain level, and that's really what the investment class is really focused on. It's really all about. Does that answer the question?
I think so. One of them said the audio quality is terrible, but that's just one comment. I haven't heard that from others. So let's move on, and maybe Will, perhaps you can move closer to the
Sure.
microphone if that makes it better. Do you take personal guarantees? I didn't think so, but you can share on that.
Great question. We do not. We really are lending to the enterprise, the business, and our view is that if you need a personal guarantee, then you can probably source the same type of capital from the bank. So we do not take personal guarantees, no.
And
And let
perhaps
me let me know if the audio is a little bit improved now.
it's a matter of me muting through it. So perhaps what I could do is just mute myself and have you go through the questions. Let's take this one though. Could you walk through the typical due diligence process? And if you have any templates, maybe we can share with the group after. But what does the typical due diligence process look like? What kind of information are you guys looking for?
Yeah, good question. So in our process, I would almost kind of think of the due diligence process as happening in two stages. The first stage is really that uh, first part of the process where almost the introductory part of the process where we're getting a sense for the company, what the company is looking for, understanding what type of facility would make sense. And at that stage, we're really looking for a pretty high level, financial information, of course, historical financials, company's financial projections. Obviously, we need a good understanding of what the business does and what they're looking to do, but that's really enough information at that initial stage, at least for our firm, in most instances, to issue a term sheet, kind of an indication of terms. And so, what that does is provides the company with an early view on, okay, this is what the deal would look like, this is what it's going to cost, and certainly it kind of gives them a reference if they're trying to uh, evaluate different options. That if the company then decides to kind of pursue this option, work with us, we sign the term sheet, at which point we kind of enter the second stage of the due diligence, which is a more in-depth due diligence. I would say is as lenders, I would suggest that our diligence is probably tilted more to kind of a financial type due diligence, so focused on the company's historical performance, financial projections, but also very important for us are specifically kind of the company's operational metrics. We spend a lot of time understanding the companies, for SaaS companies, for example, spend a lot of time understanding that company's um, kind of what's the churn experience in the business, what's the lifetime value of the customer, all of these types of metrics that over the long run will help drive financial performance. And so I think if I could characterize the diligence, it's probably more of that nature than potentially and less around the actual technology itself. In some cases, than you might find to be the case in an equity due diligence process. For us, typically, if all the information's available, we can generally get through due diligence in less than 2 weeks.
You mentioned that covenants are typically less onerous than that of debt, senior debt. Do you have covenants, and what would the typical terms look like?
Generally, our deals are characterized as covenant light, where we do have covenants. They're generally focused around ensuring that the company always has some minimum level of liquidity in the business. I think what uh, you know, we're always focused on ensuring that the company has adequate time to, react to changes in circumstance, to adjust them, to adjust to new realities, if you will, and doesn't kind of wake up one day and have and realize that um, that they're kind of running low on cash and they have a problem. That's really what our covenants are focused on doing. We don't have, for example, we don't generally include covenants that address, maintaining certain revenue levels or profitability levels. That's really not our focus. It's more around ensuring kind of continued liquidity and adequate liquidity in the business over the term of the loan. But beyond that, there are very, very few covenants in our deals.
What happens if we can't repay the loan?
Yeah, I think, look, certainly the idea, what I would say is I think and I spoke to this a little bit in the presentation, which is, ensuring that you've got a venture debt or partner, whether the venture debt or equity for that matter, that really, understands the business and understands the journey you're on. We maintain a pretty active and regular dialogue with our borrowers. Our model is not a model where we, as I highlighted in the presentation, take board seats or really get too involved on a day-to-day basis unless we're asked to, of course. But we are, always kind of monitoring the business and helping our founders and our companies ensure that they're meeting their plans. And I think the key in any situation is to act early, right, and to kind of address problems early. And so we always encourage a very open dialogue with our borrowers. If the business is not performing according to expectations, then let's have that conversation early on and figure out, how together we can help the business, get back on track. Or, if it's a situation where that's not a possibility because the company simply, can't raise additional capital and it needs that capital to continue, then, working closely with the founder and the other stakeholders to ensure a positive outcome for everybody involved. But I would say that, I think, and again, I think this is one of the reasons why it's very important to do your reference checks on your partners. Our just to kind of put some numbers to this, we're pretty careful in this regard. Our cumulative loan losses since 2009, we've been doing this for a while, are sub 1%. So we're very careful. We work closely with our borrowers to kind of help them across rough spots, and we're also very careful, frankly, to not over leverage businesses. And that's why, early in the presentation I mentioned, it's important to take the time to really assess whether the company is ready to take on debt capital, because I think there is always a risk for companies to taking on either too much debt capital or taking it on too early. And I think it's when you make that, it's when a company does that it's, I think, most at risk of having that kind of repayment issue. I think if the company is kind of got to a stage where truly is ready to take on this type of capital, it becomes a situation where it's very rarely an issue for that company to repay. And generally, you might ask, how does that happen? Very often, it's through a subsequent equity round, for example, or often the company will just have reached an age and stage, operational financial scale, where it's able to raise new capital, bank debt, for example, to refinance their venture debt loan.
Makes sense. Some questions around the timing. So, and you did talk about it through the webinar, but what is the best time for venture debt, right? So, is it a seed stage company for you guys? Is it an A? Is it a B? Now, it differs in US and Canada. In Silicon Valley, most of the or many of the VCs we work with or know or have clients in common with, when they're doing like a B round, they'll have a portion that is allocated for venture debt, typically. So, like, what are you seeing? Like, when is the right timing for you?
Yeah, I think it's an interesting question because I think it highlights um, perhaps something of a difference in approach between us and some of the other kind of players in the market. I would say that what you're referring to there, Lloyd, is a very traditional type of venture debt type investment where the venture debt bank provider is coming in alongside an equity round and is really, in some cases, really sizing that investment almost as a function of the size of the equity round. We certainly do that work, but I would say, where I think we can drive more value for businesses and companies is in helping them actually get to that next equity round, right? So in extending the runway for that company they've completed. For example, a company that has completed that Series A um, has kind of invested that capital, is seeing the results, and is enjoying strong momentum, and just wants to extend that runway a little bit longer before they go and raise the Series B, right? Just to kind of capitalize on all the kind of on the accretion associated with enhanced financial performance, top line growth. That for us, I think, is a place where we can add a ton of value, and that actually is a big part of the work we do. Whether that happens after a Series A or for a company that is pre-Series A but growing quickly, doesn't really matter. I think for us, there's no hard and fast rule, but certainly you'd be looking for at minimum $1 million of run rate revenue. I think is a good indication that a company may be at a point where venture debt's an option. May not always be a fit at that stage, but I think that's one kind of marker that the company may be there. So there's a couple of different ways that venture debt can be in a number of different junctures along the journey or points in the journey where it can be used. I think coming into complement an equity round is helpful to maximize the capital in the business post round. But I think certainly using it to extend the runway to that round and ultimately achieve a better outcome on that round, that's a way to kind of leverage venture debt and really kind of drive value for stakeholders.
Makes complete sense. In terms of you guys, what is the future for you? Where you're seeing a lot of the volume come in? Is it SaaS financing? Is it working capital? Or is it tax credit?
Yeah, certainly today, the bulk of our work is with software companies, SaaS companies in particular. They certainly make up the lion's share of our portfolio today, but Espresso has a broad venture debt mandate. We work with companies across the sector. As I mentioned before, done work in digital media, life sciences, product companies. I think, for us, really, you step away from, the specific business model. I think it's really what's the profile of the businesses that we're focused on financing. It's really, as I alluded to before, businesses that are growing very quickly, need capital to grow quickly, but of course, where the bulk of the value or asset value is really in the form of intangible assets, IP, versus tangible assets. And so for that reason, they're a business that doesn't necessarily have access to senior debt, bank debt in the same way that the businesses in more traditional sectors would. So I think, it's really that profile of business that we're specialized in. And we see those businesses and that profile of business certainly in the software sector, but of course, we see a lot of exciting businesses, with different business models, transactional business models, product models, you name it. And so I would say that as we go forward, we're going to probably be seeing more of those types of business models emerge, and I think they're going to become increasingly going to be looking to venture debt to help fund those models.
So that's all the questions, Will. Thank you a ton for making the time to talk everything about venture debt with our audience here. I'm immensely grateful. I learned a ton myself, so greatly appreciate it. Everyone, thank you for joining us today. Big shout out to Will and Espresso Capital and our presenters Launch Academy and Boast.AI. Thank you, everyone, and have a wonderful rest of the day.
Thanks, Lloyd, and thanks everyone for joining.